You do make a big deal of the Fed's jelly donut policy. It's a note that you wrote from May of 2012. You feel like real damage has been done by the Fed policy. When do you think they're going to taper, and what's it going to mean to the market when they do?
Well, first of all, I'm not convinced when or if they'll ever taper. I really don't know. We may go into the next crisis, the next depression, recession, rollover, and the next move might be to pour more fuel on the fire. It wouldn't surprise me in the slightest. That's not like my base expectation, but there's a real wide range of outcomes. What's interesting about the Fed policy is people say, well, the Fed policy is good right now. It's supporting the economy in some way. There may be some long-term negatives, but we'll deal with those later. What I think that they're missing is I actually think the Fed policy is actually a headwind to the economy. And that's what I think people aren't capturing. Last week I watched the confirmation testimony of Janet Yellen. And what she conceded was that the policy is hurting savers. But then she takes the next step and says, but the overall policy is helping the economy, so savers must be helped somehow. But what you really want to do is you want to disaggregate what is being said. When you say the policy is hurting savers, by how much? That's not that hard. You know how much is being saved. Deposits are $14 trillion or something like that, or net of liabilities, it's probably $10 trillion. Short-term interest rate sensitive in the household sector. So if rates were 2% higher, that would be $200 billion a year of incremental interest income to people, and people spend their disposable income. That's how much savers are being hurt, and the spending is not happening from that. Well, what's the other side of that? The so-called wealth effect, right? That's what's supposedly supporting things. So you can say, well, how much has the savings rate gone down? Right? That's what the wealth effect is. You're spending money that did not come from disposable income. It came from your house going up in value or stocks going up in value. Well, so here's what happened, right? In the last bubble, people were taking money out of their houses. House prices were going out. You had the cash-out refinancings, and the savings rate went to 2%. Then the crash came, and it went back to 5%. Now, if there was a wealth effect that was going on, the savings rate would go back down towards 2%, but it's not. All of the gains in the stock market, all of the gains in housing are not being spent. So the way I look at it in terms of GDP, the fact that we have zero rates is harming savers and holding back, depending on how much higher rates would be, a couple percent of GDP. And on the other side of that, there's no real mitigating benefit from the so-called wealth effect of housing and stocks. Or if there is, it's very small.
We're going to run, but my last question is, what do you think of Bitcoin?
I don't know about Bitcoin.